Hi, good afternoon. I've decided to make a recording rather than lecturing in class. We've been moving through your textbook, which is the Understanding Financial Statements, 11th edition by Fraser and Ormiston. There's only 5 chapters in this book, as I told you at the beginning of the semester, and it is really worthwhile to spend enough time in each one of the chapters studying the material. And the way I told you to approach the textbook at the beginning of the semester was to read each chapter carefully after reading the learning objectives. So on the first page of each chapter, there's a series of learning objectives that are set up, and we're going to take a look at them chapter by chapter. So you would look at those learning objectives, then you would begin to read through the chapter material, and you should use the learning objectives as questions that you need to be able to answer once you complete your study of the chapter. And by completing the study of the chapter, it means not only the reading and the note-taking that's involved in reading the textbook, because you should be taking notes as you read, either in the form of an outline or index cards, or in whatever fashion works best for you. You should also make note of any important figures and tables and charts that they show in the book that are helpful, and I'll point some of those out to you in terms of page numbers and chapter as we talk. It also includes going through the self-test at the end of the chapter. I've told everyone, and it's in the syllabus as well, that the self-test at the end of each chapter, which is a multiple choice test, you should be taking that blind. The answers are available in the book, so you can check yourself. And then the study questions and problems. The study questions themselves, those are the things that I would focus on. There's usually about 10, which are long answer or short essay kind of questions. You should be studying from those as well. And then in addition, I've been trying to assign a few homework problems as we've been going throughout the semester as we slowly move through these chapters. With us approaching just past the midway point of the semester now, I'm trying to make sure that we are organized and moving towards some final conclusion, and that everybody comes along with me and understands what it is I want them to get out of this course. And again, that always ties back to what the original learning objectives were for the course. And we will review those and see where we're at, and we'll do that in class. So first, for Chapter 1, there are 5 basic learning outcomes or objectives that you need to focus on. Be able to explain why and how financial statements are useful for decision making. 2, describe the organizations that govern accounting rulemaking. 3, describe the components of a Form 10-K. 4, explain the challenges and complexities inherent in the accounting rules. And finally, 5, understand management's impact on the quality of financial reporting. So in dealing with the first question, explain why and how financial statements are useful for decision making, well, oftentimes the simple answer really is understanding that financial statements provide sort of a snapshot and video of a company in its recent past, its most recent past, either the past quarter if it's interim statements or the past year if it's a financial statement. Financial statements often have multiple years, so that has the year of interest, this past year, and other years for comparison. Some additional information that may be provided in the annual report outside of just the financial statements would include other comparative information that may go back even longer. It could go back 5 or 10 years. That information is useful for decision making in terms of, again, we're talking about external users. We're talking about potential investors, regulators, and folks outside the company. Well, most of those folks, if they're from the investor class, they're coming in as one of 2 types. They're either equity investors looking to purchase stock, or they're creditors looking to extend credit so that the company may be looking to take on some debt. This could also include bonds. where you've got somebody trying to put together a subscription for them for selling bonds, and then people on the market trying to buy bonds. Because again, bonds and stocks are both attractive investment vehicles for different reasons. You'll learn that in finance. So what are they trying to do? Well, they're trying to figure out how to allocate their own capital, their own financial capital. How much are they willing to spend? Is this the right choice for them? And they'll use information from the annual report and specifically from the financial statements to make those decisions. And so that's really kind of the primary use of the financial statements. People want to keep track of how the company's doing. And they use that information to decide whether they want to do business with this particular company. Now, again, there may be a little bit more than that in the textbook, but that is the basics of it, okay? The next question, describe the organizations that govern accounting rulemaking. Well, we've talked about that at length as well. Essentially, before the crash of 1929, there wasn't really, I guess, a real organized attempt to regulate the finances of companies. Since the crash, of course, you had the Securities and Exchange Commission formed as part of those acts of 1933 and 1934. The Securities and Exchange Commission was given the power to set accounting rules by Congress. The SEC turned around and they delegated that authority or power to the FASB, the Financial Accounting Standards Board, which is run by the Financial Accounting Foundation. And they set the rules for the reporting companies. And reporting companies are those that sometimes are referred to as public companies. Sometimes they're referred to as issuing companies, but they are private commercial businesses that are required to report to the Securities and Exchange Commission. And those reporting companies, again, they can get involved in the process by directly lobbying Congress for changes in accounting rules, trying to influence the Securities and Exchange Commission, and also trying to influence the FASB itself. So it is a dynamic political environment which kind of creates some problems, if you will. It's not a perfect system, but by and large, it seems to be working okay. But because we have scandals that come up and significant frauds that occur, that could be evidence that the system has some problems that are significant enough that they need to be dealt with. But that's beyond our discussion right now, but it's something interesting to think about. Another complicating factor with standard setting in accounting is the fact that we live in a global economy where individual countries have their own sets of accounting rules. And there are two major systems. There's GAAP, Generally Accepted Accounting Principles here in the United States, and then there is the International Accounting Standards Board in Europe that puts out IFRS, which is the International Financial Reporting Standards. But beyond that, there are a lot of other smaller sets of standards that exist within individual countries that we don't necessarily talk about, but do exist out there. So there's lots of room for complications here. So let's move on to the next one. Describe the components of a Form 10K. Well, there's a nice chart or a nice figure that's in Chapter 1 on page 9, and so I'm going to recommend that you go there and make sure that you either make a copy of this and put it in your notes or star it, do something. But it lists all 15 items, and some of the items have multiple parts to them, and what they're associated with. So like for item 1, it's business. Item 1A is risk factors. Item 1B is unresolved staff comments, and then it moves on from there, all the way to item 15, which is basically all the exhibits and schedules that come with it, and also any of the reports on Form 8K. And remember, we went over 8K. 8K is when something happens and it needs to be immediately reported to the business community at large. Okay, so that's important for understanding what each of the items are in 10K as you go through it. And remember, when I say financial statements, or the financial report, I'm talking about the core financial statements and, of course, always the notes. The notes are part of the financial statements. They're part of the financial report. Okay, there's the annual report, there's the 10K, and there's the financial statement report. And so those are three separate things that you can talk about. Many times companies combine the annual report and the 10K together and just include those additional items on the 10K that aren't necessarily part of an annual report. Sometimes you can go to a company's website and they will actually have a separate annual report for investors and the 10K available, and then maybe a separate file for the financial statements and the notes to the financial statements. All right, so that tackles item number 3. Now we go to objective number 4, explain the challenges and complexities inherent in the accounting rules. Well, we kind of already started to do that. One of the things we mentioned is that, one, it is a political process. So we've already said that. So setting the rules is difficult. Coming up with a rule that makes sense sometimes is difficult. Sometimes they want to do something and move forward with an initiative that makes sense from an investor standpoint, but isn't popular in other circles. And so through the political process of rule setting, they kind of fight it off, and that rule never sees the light of day. Or maybe they change the rule and it isn't as effective as maybe one would hope it would have been. Okay, and there are some examples of that laid out in the book for you. One item to notice, spend a little bit of time reading up on management's discussion and analysis. In this course and in your strategic management class, there's going to be a lot of nuggets of information within the MD&A that's going to be very, very useful to you. And again, in figure 1.3 on page 13, spend some time looking at that and checking to see, hey, what is included in here? And they talk about 7 items for management's discussion and analysis. They have the internal and external sources of liquidity, material deficiencies in liquidity and how they will be remedied, commitments for capital expenditures, the purpose of such commitments and expected sources of funding, anticipated changes in the mix and cost of financing resources, unusual or infrequent transactions that affect income from continuing operations, events that cause material changes in the relationship between costs and revenues, and breakdown of sales increases into price and volume components. Each one of those, in and of itself, is very, very important. Notice how first they focus on liquidity, and liquidity is how quickly can we get our hands on cash. Very important for a business. Cash is king. Second, they begin to look at big major purchases, what they call the capital expenditures, and they ask the question, where are they going to get the funding from? So what's the use of the equipment? And where is the money coming from to pay for it? Because what they're getting at here is the mix between equity and debt. And the very next question they ask is the anticipated changes in the mix and cost of financing resources. Well, sorry about that. I was interrupted for a minute. My wife called up wanting to know what kind of salad to pick up for dinner tonight. So the hazards of trying to make a recording at home. So can't do it up at school because we've got like 5 people crammed into a single office. So you can imagine what that's like. 5 faculty members that can't shut up, all in a room trying to get work done. Ha! You know, go figure. At least I have a sense of humor about the whole thing. So at any rate, so we were just getting off of management discussion and analysis. So the focus again is on liquidity, cash, how quickly can they get their hands on it, the mix between debt and equity and how it's going to be used in terms of purchasing capital equipment and buildings and so forth. The other piece of this, don't know why that happened. A few little hiccups here. Something happened with the screen. At any rate, so again, we're talking about liquidity, we're talking about debt to equity, And then we're also talking about changes between the relationships of costs and revenues. Remember, the income statement equation, much like the balance sheet equation, the income statement equation is revenues minus expenses equals net income. And so any changes in that relationship between revenues and costs is going to be important to track. So if revenues stay the same and costs go up, net income goes down. So it's really simple. It's like a scale, and anything that changes on the scale could affect the final outcome. And the same thing with assets equals liabilities plus equity. Anything that changes on one side of the equation has to have a change or an impact on the other side of the equation. And those things actually mean something. And so it's what that means, that's why people track them. So if assets go down, something else has to go down on the other side of the equation. Just like if revenues were to increase, if costs stayed the same, then net income would go up. If revenues go down and costs go up, that could result in that would probably result in a decrease in income on the other side, but it's going to depend upon how much change takes place. Okay, so it all has to be looked at very carefully, and so you can see that it is kind of a delicate balancing act, and folks look at that stuff carefully. And so finally, they break down sales increases into price and volume components. And again, that's important because if there's any change in the amount of sales revenue that's coming into the company, you want to understand how much of it is associated with changes in price versus how much of it is associated to changes in the volume of what's been sold. I think that makes perfect sense. And again, this figure 1.3 on page 13 provides you with a really nice summary of that information. So please make sure you focus on that some. Well, let's see, what else do we have here? Again, there's a lot of information in this chapter, and so you really do need to go through it yourself. But I'm just trying to provide some basic information. The Appendix 1A for Sage Inc., that's a good place to kind of read through a management discussion and analysis to see what's typically in there. Also, they have the auditor's report and the financial statements for Sage Inc., so I would spend some time going through that. Understanding management's impact on the quality of financial reporting. One of the things you have to remember is there's a lot of issues in financial reporting. It isn't like physics or chemistry where measurements are kind of really important in terms of if you don't measure things in the right quantities, then you won't end up with the right outcome. It isn't like the force of gravity where we know what's going to happen when something is dropped from a distance. We can make calculations and figure that out. Unfortunately, there are a lot of things that are more qualitative in nature in our world because business is a social science and accounting is a communication tool within that social science. And so it's not a hard and fast science. It's just the use of numbers in place of other forms of communication. But those numbers have an origin. Somewhere, somehow, those numbers were born. And how those numbers were born, that affects what that number really means. And so, for an example, look at the valuation of inventory. So if I'm looking at somebody's balance sheet and I see an inventory number, it's important for me to know how they calculated that number. Was it calculated using first in, first out, last in, first out, or weighted average, maybe specific identification? That's important. Are they using the lower of cost or market, the LCM rules, lower of cost or market? Look at all of the characteristics, assumptions, principles, and the basis of accounting itself. They talk about materiality, comparability, consistency, the going concern assumption, the time period assumption, the monetary unit assumption, the revenue recognition principle, and the matching principle. Those two you should be well aware of because they've been on the test, because those two are very important. Again, the revenue recognition principle, it requires 4 conditions be met in order to recognize revenue. And then the matching principle says that we're going to recognize the expenses with the related revenues. Okay, then you've got the difference between the cash basis and the accrual basis of accounting. I noticed on the quiz that we took earlier this semester that a lot of people mixed up between the two recognition principles and the accrual and cash basis issues. So try not to get those mixed up. So management has a lot of choices, a lot of decisions that they can make that affect a lot of different numbers: the accounts receivable number, the accounts payable number, the value of fixed assets on the book, the value of inventory on the book. There's a lot of issues that management gets to decide, and so that means you need to know a lot about that particular element on a financial statement. It isn't just a matter of looking at a number and taking that number for granted. So you see a 10 on the financial statement. Well, the first thing you have to look at is, what is that being reported as? Maybe it's being reported in millions, and so that 10 is really 10 million. And then what does that 10 million mean? Well, the 10 million is tied to a line item on the balance sheet, and it's reported alongside maybe furniture and fixtures or something like that, or maybe it's an accounts receivable number. Okay, well then how did they measure it? Well, you need to go into the notes to determine how they measured accounts receivable. And of course, it's usually reported net. What is it net of? The allowance for doubtful accounts. Well, how did they determine the allowance for doubtful accounts? A management decision. But it will be explained in the notes to the financial statements. So you need to go in and read that to figure out how they determined what accounts they believed were going to be collectible versus uncollectible. So again, that kind of takes you through the 5 learning objectives, and you should be able to have an intelligent conversation and be able to ask questions. If you're talking about a company, like we were talking about Kraft Heinz, you should be able to start asking certain questions of what you're reading and trying to determine basically what are the issues here. I'm being presented with a situation that has come up, and so I asked myself some basic questions about why this might be happening. And so you've got the beginnings just from chapter 1 of some useful tools to start asking the right questions to understand more about the situation. So in the next segment of the video, I'm going to be talking about chapter 2. Again, I'm trying to keep these to about 20 minutes or so a piece, just to give you a kind of a broad overview of what's included in each chapter, so that it'll help you as you go through and do the readings yourself. All right, I'm back. And we're going to take a look at Chapter 2, the balance sheet. It starts off with a joke, one that I had heard before, but old accountants never die, they just lose their balance. Waiting for the laugh on that one. At any rate, notice here we have a few more learning objectives than we had for Chapter 1. Chapter 1 was kind of an overview, an introduction, but still in all gave us a lot of useful tools, a lot of useful information for being able to begin to ask the right questions of the information that's contained in a 10K or in an annual report or within the financial statements themselves. Chapter 2 now is going to focus in on the balance sheet, and so we're going to be looking at assets, liabilities, and equity. We're going to be looking at the measurement and valuation of the items on that particular financial statement. And so we explain the content and purpose of the balance sheet. Well, it's the accounting equation. It contains the assets, liabilities, and equity. It also explains it visually. There are certain ways to display the balance sheet. We typically put from most liquid to least liquid, and we also put it in current to non-current or long-term. The assets tend to be reported first, and then come the liabilities and the equity, and it can be a top-to-bottom presentation or a side-by-side presentation, where assets are on one side, the liabilities over equity is on the other side. Prepare and understand a common-sized balance sheet. Well, I'm going to have you guys do an exercise in this, but basically the common-sized balance sheet is where we take any line item in the balance sheet, we'll take every line item in the balance sheet and divide it by total assets. Remember, we can do that because the total assets has to equal total liabilities plus owner's equity. So those numbers are the same. So I only talk about dividing everything by total assets because there's no sense in talking about any other number. So we divide them all and we end up with a percentage. Now the power of that is that what used to be just a dollar figure is now a percentage, which is a relative amount, which means that I can compare that relative amount with relative amounts from past years and also other companies of different sizes. Because if I have a company that is, say, has $10 million in total assets, that's going to be a lot different from a company that has $100 million in total assets. And their line items are going to be really different. And so when you look at them and try to compare them, it's really hard to do any meaningful comparisons visually that way. But if you turn these into percentages, all of a sudden, wow, a picture appears before you that gives you a sense of, wow, this, even though one company is bigger than the other, they have a lot in common, or they don't have a lot in common. But you'll be able to see it a lot more clearly when you turn everything into percentages. And again, we'll do that as an exercise. List and describe asset, liability, and stockholder equity accounts. I've had you guys do that. I'm not going to spend a lot of time talking about it. But again, you've got assets from cash all the way down to your intangible assets. Again, that's the order of liquidity. You've got your liabilities, which start off with like your payables and move all the way down to your longer term, like bonds and long-term notes payable. Sorry about that. And then stockholder equity accounts, which in a simple set of financial statements is basically common stock account, maybe an additional paid-in capital account, and then you have dividends and retained earnings. And so that's pretty much what you'll see on a basic one. Now, you look at a more complex organization, there will be some more in there. There may be common stock and preferred stock. There may be different types of common stock, different types of preferred stock. There'll be the other comprehensive accumulated comprehensive income in there. So there'll be a number of different things that will show up in a major corporation's equity statement. Then we get to analyze the accounts receivable and allowance for doubtful accounts to assess earnings quality. This is important in the sense of what do they mean by analyzing it? Well, we're looking for changes. We're looking for changes, and we're looking to see does the accounts receivable and the allowance for doubtful accounts, do they kind of move? There's a relationship between those two accounts, or at least there should be. If it's being done in some rational, systematic fashion, then there should be a relationship between those two, and it should be consistent over time. If you're noticing that the relationship between those two items is different over time, and maybe it's moving in one direction or another, that could be indicative of some management decisions that are being made, and you need to understand what that could possibly indicate, because it could be a red flag for some problems. And so you want to take a careful look at that. And there'll be some problems. I'm going to assign a problem to you guys that will get you looking at that, because I think it's important. We also are going to take a look at compare the effects of FIFO, LIFO, and average cost inventory methods on the financial statements. Again, it assumes certain things. It depends on inflation. If inflation is increasing, if pressure on prices is that prices are increasing, then what you bought yesterday will cost you more today, and will again cost you more tomorrow. And so if you're buying raw materials that are increasing in price over time, that means the value of that item that you're putting into inventory is going up over time. So if you are using a last in, first out method, it means what you're going to be doing is matching up the sale of an item with the higher cost, most recently purchased items in inventory. Even if they're being pulled from inventory based on kind of the age, meaning that the newer ones are left in and they take the older ones out, that doesn't necessarily mean that the costs are associated the same way. So the costs can be associated independently of the physical units of inventory themselves. So LIFO says, hey, we're going to match the costs of the ones we're buying now against the revenues of the ones we're selling now. And that's legitimate, and that gets you a good matching. The problem with it is that when you look back at the older inventory or the older costs for the inventory that are left behind, that means that you're going to have a lower cost of inventory on your balance sheet. So the inventory line item will have a lower cost than what it would cost you to replace it, because it's going to be based on the first costs you paid, which were the lower costs. With FIFO, you're going to have a higher cost of goods left on the balance sheet, but you're going to have a lower cost of goods sold on the income statement because you're matching up the lower first costs against the current sales. And so you end up with lower cost of goods sold against the revenue that's being generated, creating a greater net income, but you also have a higher value of the inventory that remains on the balance sheet. So hopefully you can kind of visualize that. Average cost inventory method is supposed to moderate that effect, and so it'll come in somewhere in between. And so companies have to decide how they want to report things. And this is a question that gets tied closely to their tax situation, because the IRS has some rules that affect how you can report things for tax purposes versus how you're reporting things for financial reporting purposes. You'll hear more about that when you take a tax class. I won't get into it here now. They may talk a little bit about it in the book, but I'm not going to bog us down into that set of weeds right at this time. So we need to understand differences in depreciation methods and calculate depreciation of fixed assets using the straight line and double declining balance methods. So again, I told you I wasn't going to turn you into accountants, but I do want to make sure you understand the difference between the straight line method and the accelerated method, in this case, double declining balance method. I'm going to assign you a problem that's going to give you a little bit of practice to do that. Again, depreciation, if you take more depreciation early, depreciation ends up being an expense. It's a depreciation expense. A higher depreciation expense means a lower net income now. But if you are increasing the amount of depreciation expense you take now, it means that later on you're going to be taking less. And so you're going to basically see net income increasing. If nothing else changes, it's only going to be increasing because the amount of depreciation taken is reduced over time. Straight line means a consistent amount of depreciation expense is taken out over time. It's a very stable calculation. And we'll take a look at that in a problem. Then we evaluate assets, debt, and equity structure on a balance sheet. Remember, we talked about that a little bit earlier, the difference between financing with debt versus financing with equity. There's real costs associated with that. You have a dilution of the ownership structure if you go forward with an equity financing arrangement. If you use debt, you're going to have interest expense associated with that. And companies and people outside will look at the company and they'll assess that debt to equity ratio. And they'll also look at things related to assets. So they might want to know what the return on assets or the return on equity, and we'll get into that with financial statement analysis. So how efficiently are assets being utilized to take advantage of their potential, their income generating potential. And so we look at return on investment, return on assets, and return on equity. Those are three important ratios that we will end up talking about. So they look carefully at the relationship between these different balance sheet items or sets of items here, and they pay attention. Sometimes they're even so important that they build them into the loan agreements that banks or financing companies, when they loan money to the company, they will have clauses in their contract with the company that basically set numbers and say, hey, you can't deviate from this, you can't be outside this range, or you can't pass this ceiling, otherwise the loan can be called. So this can be some pretty serious business. And then finally, identify qualitative issues on the balance sheet that may be of concern to analysts. One of the biggest concerns they have with the balance sheet is something called off-balance sheet financing. And off-balance sheet financing typically gets into a discussion of leasing. And what I mean by that is operating leases versus capital leases. And there's a whole big issue with operating leases, which don't really have anything, they don't have much of an effect on the balance sheet because they are a lease, they're like a payable, and so they show up as a current liability, just a small portion of it, and as an expense on the income statement. And so they can hide some future liabilities by having them classified as an operating lease versus a capital lease. And there's a lot of discussion in the accounting community whether operating leases should exist at all, and maybe all of it should be capital leases. Issues related to pensions and post-retirement benefits are often times considered important to look at. So you'll want to look at that. Look at the deferred taxes example on figure 2.2, which is on page 69. Pay careful attention to that and read through that scenario. There's a section right before it starts on page 67 and goes over on to 68. And we've talked about this in class. I want you to go back through this carefully and look at it carefully, because this is going to be on your final exam, and you really do need to understand it. It's an important concept. All right, let's see. What else do we have here? Again, make sure you do the self-test for this chapter. And so that kind of gives us a brief overview, I guess about 12 minutes or so overview of Chapter 2. Again, read it. Take your notes, study it, take the self-test, see how you do. Don't play peekaboo. Don't be looking back. Answer them as if it was a test in a classroom to see how well you do, and then go back and troubleshoot what it is you had problems with. And don't hesitate to ask me questions. The next segment, we'll be taking a look at Chapter 3, and so we'll get to that in a few minutes. I'm probably going to take a break here. You won't know that because I'll just turn the recorder off. But at any rate, I appreciate you guys that spend the time listening to this, and I really do hope it's helpful to you in working through these chapters. I thought about doing this earlier, but I didn't have the software that I needed on my computer. I now have it, and since I'm going to be teaching this class over the summer, I thought it would be good to put this together. At any rate, I'm going to go ahead and pause this recording. This is the end of our discussion for Chapter 2. Again, when you turn this back on, or if you continue to listen through, it will come up with Chapter 3. All right, I'm back with the third installment of our review of understanding financial statements. I took a break for dinner. Actually, dinner was pretty good tonight, if I don't say so myself. I cooked it myself, but I'll show you the gory details. I'll spare you from the gory details. All right, so we're going to be talking about in Chapter 3 the income statement and the statement of stockholders' equity. Those two statements are pretty important. One, again, income is sort of the performance measure that a lot of people look at in terms of how did you do this year. Well, what they're asking is how much income did you report? Another way to look at it is, we're going to get to it in Chapter 4, but it's also how much cash did you generate. That is another way of looking at it. You can't really look at one at the exclusion of the other. They really do need to be looked at together to determine really just how successful the business's year happened to be. And so the first item is explain the purpose of the income statement. And as I said, it is a way to communicate sort of a performance measure for a company. How did they do? How much income did they raise with the money that they spent? So, revenues minus expenses equals net income. Well, they want to maximize the difference between those two numbers. They want to squeeze out as many revenue dollars as they can from the costs that they're going to incur. And so think of it as like when you're squeezing an orange to get juice out of it. You want to get as much juice out of the orange as you can. Ideally, you would like to extract every bit of juice out of every bit of orange that you have. And so that's what companies try to do. It's the idea they want to be as efficient and effective as possible, and they want to be economical. So they want to spend what they need to spend to generate the level of income they are looking to generate. Preparing a common-sized income statement is similar to preparing a common-sized balance sheet. Same general idea, except this time everything is based off of net sales. So everything is a percentage of net sales. So every line item on the income statement can be expressed as a percentage of the net sales total. Net sales would be 100%, and then everything else below it would be a percentage off that. And so you'd be able to measure the percentage for gross profit, which would be, 100% of net sales minus some percentage that represents the cost of goods sold equals the percentage of gross profit that they earned, and so on down the line until you get all the way down to what percentage of net income. So if you look at it and you say, well, they made 5.5% off of their net sales, that means that 5.5%, 5.5 cents of every dollar earned went into profit. That's essentially what that means. And how is that valuable? Well, it's valuable from a comparative standpoint because you can compare it and see how they've done in the past and how they're doing currently to see are they maintaining, are they growing. You can also look at it in relation to their competitors. How are their competitors doing? If their competitors are doing a lot different, if they're doing better, why are they doing better? If they're generating 5.5 cents out of every dollar, their competitors are getting 7.5 cents per dollar of sales. It would be legitimate to question why that is. And so that's what companies use this type of information for. So that's the value, again, of the common size income statement, is it allows us to prepare a better analysis of a company over time. Sorry about that, I need to get a drink. I got the new orange vanilla Coke Zero. It's very good if you haven't tried it. It's like having a creamsicle in a glass. Well, anyway, so the third item, list and describe the operating and non-operating revenue and expense accounts. You always need to be able to break down the income statement because you want to look at it a couple of different ways. So operations, that's the core of what we do, and non-operating is some of the other things, the non-essential, what you would consider maybe the non-essentials in terms of operations. They may be very important in terms of running the business, but they are not things that directly went into the running of the business. So like when we look at a typical income statement, and you can see one in Exhibit 3.3 on page 107 for Sage Inc., and it has under operating expenses items like selling and administrative expenses, advertising, depreciation and amortization, impairment charges, and then operating profit. And then it has interest income and interest expense as items that are outside of operations. And so you need to be able to go through a list and decide what's part of operations and what's not part of operations. So make sure when you're reading through this chapter that you're spending time understanding what these different divisions are. Know what's continuing operations versus discontinued operations. Know the difference between something that is an extraordinary item versus something that isn't. An extraordinary item is something that is both infrequent and unusual. If it's just one of those, infrequent or unusual, it is not an extraordinary item. So just lots of different ways of looking at things, and you need to understand all of it. Make sure that you understand when people are talking about gross profit versus operating profit, what they're talking about. So with gross profit, they're looking strictly at sales and cost of sales, or cost of goods sold. When they're talking about operating profit, they're looking at everything that went into making gross profit and then all of the operating expenses. And of course, if they go to net income, they're looking at those other non-operating items. Okay, so that's what they're kind of looking at. And so when you analyze the profitability of a firm, that's essentially what you're doing, is you're looking at it from a number of different perspectives. And they look at it, when they go through and they break it down, they look at things like looking at the cost of goods sold compared to net sales, the gross profit compared to net sales. They look at the common size statements. You can look at any particular expense line item in the income statement against net sales and look at that over time to find out how that's changing. So not only can you look at just the bottom line in general, but you can also look at individual items to see how the relationships are changing. And then try, again, it's nice to know, it's a good thing to know that something changed. It becomes more important to know why it changed. Understanding the reasons behind it. We know how it changed, we just don't know why it changed. And so that's the investigative part of it. You have to go and take a look at it. So pay careful attention to that section. Explain the purpose of the statement of stockholders' equity. So we're looking at stockholders' equity. Stockholders' equity is basically it is a reconciliation. And so it looks at, the number of shares outstanding at whatever price, whatever the par value is or stated value is. Anything above that is considered additional paid-in capital. And then they also have your cash dividends that have been paid out, because those, again, reduce retained earnings, and retained earnings is tracked. And so they typically will look at changes in any one of those types of categories. They're going to be looking at the common stock and additional paid-in capital, and then the retained earnings. They'll have a beginning amount, they'll have increases, and they'll have decreases, and then they'll have some ending amount. So it's basically a reconciliation. It's similar to that other important formula I told you about, where you have the beginning balance plus any additions minus any deletions equals some ending balance. And so it's that same idea that we've used to look at other accounts within the financial statements. And then in this chapter, there's a really good, the last section is about earnings quality, and that section is really short because starting on page 123, there is an appendix called A Guide to Earnings Quality. I strongly encourage you to read this section carefully and make sure that you understand the content and be prepared to ask me questions in class. Because we will talk about this some as we go through the rest of the semester. We have had discussions about some of this already. Now it's all fair game because we're covering it. And so it's now out there, and it's going to be part of assignments that you have, and it will come into play both in the case you'll be working on shortly and also on the final examination. So Appendix 3A is really important, and you need to spend some time in there. So, and there's a lot of things that affect the quality of earnings. Essentially, anything that is discretionary, anything that's an estimate that management can make a choice about how they want to approach it, anything that's subject to some kind of strategy, that if you could strategize and do something, you can manipulate the earnings numbers. And so therefore, the quality of the earnings is dependent upon a number of different things. There are lots of different factors that explain the quality of a company's income numbers. And so that's going to be really important to go through and understand. Again, one of the quick ways is that, hey, I want to understand the quality of the company's income. Well, how much of it was generated from continuing operations versus discontinued operations? How much of it was from operations versus non-operations? How much was generated initially at a gross profit? How are operating expenses being managed? So if net income appears to be low, but gross profit appears to be high and growing, then there could be a problem in that operating area. And so maybe that's where you want to zero in. So lots of information that you can pull from this. So very, very important. And so that's kind of a summary of Chapter 3. Make sure, again, that you read it, that you take notes by outlining the chapter, asking it questions, taking the self-test at the end, and then doing any homework I'm going to assign to you for the balance of the semester. So that is Chapter 3. I'll be back in a few moments to talk about Chapter 4. Well, welcome back to our walk through the financial statements as we look at each of the chapters in brief for Understanding Financial Statements, the 11th edition of Fraser and Ormiston. Again, they do a very nice job in a small book, 5 chapters and a few appendices, of giving you an overview of the financial statements for you to be able to read them, work with them, and get something out of them. Because again, the financial statements, the annual report, tell a story, and you want to understand what that story is. And there, again, as with any event or series of events that occur, there may be multiple stories. And so there's the story that the company tells, but then there may be a story that you tell. You may see things differently than the way the company wanted them seen. Because, again, a lot of things are about managing perceptions. And so that's important to consider. This chapter, Chapter 4, starts off on page 161 with a little, kind of a little scenario written in some prose. It's called Joan and Joe, A Tale of Woe. Joe added up profits and went to see Joan, assured of obtaining a much-needed loan. When Joe arrived, he announced with good cheer, "My firm has had an outstanding year, and now I need a loan from your bank." Eyeing the statements, Joan's heart sank. "Your profits are fine," Joan said to Joe, "but where is your company's cash flow?" "I'm sorry to say the answer is no." So you can generate profit and have no cash, and that's going to be a deciding factor in whether somebody's going to be willing to give you a loan. So cash is very important, and hence that's why the statement of cash flows exists. The statement of cash flows, much like the statement of stockholders' equity, is a reconciliation statement. It reconciles the beginning cash balance with the ending cash balance and tells us why cash either went up, went down, or stayed the same. Because if you're just looking at the difference between two balance sheet reporting reports, and one shows cash balance of X and the other one shows X plus or X minus something, that's fine, but you don't know why it changed. And that becomes really important. Again, we're going to look at defining and identifying operating, investing, and financing activities. That's going to be integral to understanding the statement of cash flows. So it's very relevant. I told you in the previous video segment that with income is great, it's important, it's good to be generating positive income, but if you don't have cash, if you do not have a positive cash balance, then that could be a bad thing. So when we look at the statement of cash flows, we look at those three groups of activities: operating, investing, and financing. Very important to get the difference between them. Operating are those things that we're in business to do. So if we're a McDonald's, we're in business to make and sell food. All right. If we are Walmart, we're in business to keep it simple. We buy goods and sell goods to people, retail. That's what we do. All right. So anything that's operating activities is associated with those sales. Investing has to do with our assets and how we pay for them. So we need stores, buildings, equipment, that sort of thing. And so how are we going to fund those? Are we going to purchase them outright with cash? Are we going to take out loans? All that stuff gets captured in the investing section. Also, we take our cash balances that we don't need right away and we put them into investments. So that turns out to be part of the investing section. So it's basically the purchasing and the sellings of some of those assets, mostly of a longer term nature. Finally, the financing activities have to do with capital generation. And this has to do with the old question of do we capitalize with debt or do we capitalize with equity? So stock transactions with owners, that's going to be captured there. In addition, if any debt is taken on, if we're going to finance the capital through debt, that could show up in the financing section as well. So at any rate, so just to give you that brief overview, we want you to be able to prepare a statement of cash flows and then to prepare a summary analysis of the statement of cash flows and then finally analyze a statement of cash flows. I think we're going to have to do that in class. I don't think I'm going to be able to talk through that on here because this is a difficult concept in and of itself. Figure 4.1 on page 166 in your text gives you how cash flows during an accounting period. It's a really good kind of textual picture of how the cash flow works. So it shows you for operating activities what some typical inflows are and what some typical outflows are. And they show you the same thing for investing activities and financing activities. So I'll give you one example for each. Under operating activities, a typical inflow would be cash from sales of goods or services. Makes sense. We sell for cash, cash comes in, goods go out. So that's an inflow of cash. Outflows would be payments for purchase of inventory. So we buy inventory to come in, cash goes out. And so that's the outflow. That's an example of an inflow and an example of an outflow as related to operating activities. Then under investing activities, we have cash from sales of property, plant, and equipment. So any selling of property, plant, and equipment that generates cash for us, that's an inflow under investing activities. And then for outflows, it's the purchases of property, plant, and equipment. Okay? And so that's important. And then loans, principal to others. Okay? And so the principal gets recorded here, because that's the cash flow in for investing activities, or the cash flow out for investing activities. So purchases of property, plant, and equipment, and loans, principal to others. That's the examples for investing. Then in financing, we have inflows are proceeds from borrowing. Okay, pretty simple. Then outflows, the repayments of debt principal. All right, so that's cash coming in and cash going out. And so you have the total inflows less total outflows equals the change in cash for the accounting period. So that's kind of the important part of Chapter 4. I think that is probably where we're going to leave off here. We are going to look at some of this, and I'm going to assign you some homework. But again, you need to be reading through this chapter, making your notes to yourself, and then you need to complete the assignments that I'm going to give you. There is also an appendix that covers the statement of cash flows, the direct method. The chapter talks mostly about the indirect method. The indirect method essentially starts with net income and then adjusts net income to come up with cash inflow or outflow from operations. The direct method looks at the differences between the balance sheet items and derives the net cash inflow or outflow from operating activities. So two different approaches that come up with the same exact number. The indirect method is more popular because it's easier. The direct method is more informative to external users of the financial statement. Most companies here in the United States use the indirect method. In Europe, under IFRS, they use the direct method. Okay? So I'm going to stop right there. There'll be a separate video piece that'll come up for Chapter 5. But for now, I've spent almost an hour talking about these first 4 chapters. And I want you to go through and spend more time in each one of these chapters reading, taking notes, studying, and practicing. That is very, very important if you want to master this. And honestly, you should want to master this. This is part of your training for sending you off into the working world. And this will help prepare you to be able to do that. So I appreciate your time. I'm sorry this may be a little bit choppy. It's kind of my first time, and it's the longest video I think I've put together so far, and I'm going to need some practice at doing this. So I appreciate you bearing with me. And I would like to get some feedback at the end of the semester about any of the videos that I do, as to just how helpful they are. Did you listen to them? Did you find them useful? Did they help you understand anything? And then what I could do differently with them. So that will also be quite helpful. Again, thanks very much, and we will be back soon to cover Chapter 5.